Stocks and gold bounced back overnight after Donald Trump downplays his new 100% China tariff threat. China's exports are stronger than expected, and New Zealand's traffic movements suggest an economic turnaround has started. That's coming up in our 5 Things in 5 Minutes on Tuesday, October the 14th. And then in our deep dive interview, ANZ's chief economist for Greater China, Raymond Yeung, suggests looking through the latest noise around the US-China trade dramas.
The whole idea I like to provide of all this China-US saga is that the economic decoupling is underway.
But first, in 5 and 5 with ANZ, US stocks and so-called risk-on assets, including gold and the Australian dollar, rebounded strongly overnight as Donald Trump downplayed his comments about a big new tariff on exports from China. US stocks made back most of their losses from Friday, and gold jumped another 3% to a new record high. Here's ANZ Head of FX Strategy, Marja Bin-Zaman.
Both President Trump and JD Vance have somewhat provided some offsetting comments to the aggressive stance they had on Friday, saying that they are open to reaching a deal with China, paring back a little bit of those comments that they came up with on Friday. Look, this suggests that the US is possibly keen to maintain pressure on China, but at the same time reassuring markets that there is room for negotiation.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 1.5%. And the Nasdaq up 2%. The 10-year US Treasury yield rose 1.6 basis points to 4.071%. Gold rose 3% to $4,121 an ounce. West Texas oil futures rose 1.2% to $59.70 US a barrel. The US dollar index rose 0.3%. The Aussie dollar rose 0.7% to 65.2 US cents. And the Kiwi rose 0.2% to 57.33 US cents. Number 2. Despite all the tariff drama, China's exports grew 8.3% in September from a year ago. That was much better than the 6.6% growth expected as the consensus. ANZ's chief economist for Greater China, Raymond Yeung, explains.
The Chinese exports still very strong, partly because of the global electronic cycle. We all know, how popular the new iPhone is. The smartphone basically drive the whole electronic supply chain. China is not just producing smartphone for Apple, but also a lot of different parts and peripheral products related to new models. So whenever there's a new and popular electronic device, that's usually support the Chinese export number.
Number 3, the US government shutdown has extended into its 14th day today. But Marjabin says it's not moving markets much yet.
So the focus really isn't on the US shutdown at this stage. And it is quite difficult to have a view on the dollar based on domestic economic data when you don't have the latest data releases. I think as we get closer to the FOMC meeting, which is at the end of the month, I think if the shutdown of the US government persists until then, it could be that, market expectations for the 25 basis points cut that is fully priced in right now may start to reduce, given that we have missed the non-farm payrolls data.
Number 4, India's headline CPI inflation rate of 1.54% from a year ago was in line with expectations, but ANZ economist Dheeraj Nim reports core inflation rose by around 0.3 to 0.4 percentage points.
This is important from monetary policy viewpoint because currently low headline CPI inflation is because of base effects as well as food prices. And going forward, because inflation is expected to start rising in FY27, Monetary Policy Committee will a good amount of importance on core inflation trends in determining how much more monetary policy space there is to ease the policy rate. We expect at least one more 25 basis point rate cut by the Monetary Policy Committee in December 2025.
Number 5. In New Zealand, ANZ's Trachometer series, which measures light and heavy traffic movements in September, showed the economy may be coming out of its downturn, as ANZ Chief Economist for New Zealand, Sharon Zollner, explains.
So light traffic, that's mostly cars, that tends to be correlated with consumers' mood to spend, whereas the heavy traffic's more correlated with production that's happening in the economy. That's actually come off its highs, but it's been much stronger this year than the light traffic. Perhaps it reflects that the agriculture sector has been absolutely booming, but prices are off their peak a little bit. Maybe things are starting to cool a little bit there, whereas the light traffic's been in a hole and is starting to look like it might be coming out of it. It's early days, it can be quite volatile. So we'll have to see if it sticks, if it's sustained, but it is looking more like a turning point.
Horizontal there. Now, in our deep dive interview, ANZ Chief Economist for Greater China, Raymond Yeung, says it's worth looking through the noise of the latest trade drama between the United States and China to find the signal.
I'm increasingly insensitive to this term, tariff, be it 100%, 145% or 30%. I call this new normal because China and the US have engaged in a cycle or a repeated cycle of trade tension escalation, countermeasures, and then come back to the negotiation table. So this cycle seems to persist and becomes a new normal and part of life for both sides. But the whole idea is I like to provide of all this China-US saga is that the economic decoupling is underway. And since Trump 1.0 back in his first term and now the second term as well, that China's export to the US has dropped a lot. It's even by 1/3 in the first couple of months and now down to only around 12 to 13% of the total share of China exports. So I think that this more the theme that I'm seeing in terms of the China-US economic and trade relationship. So they have to accept that because both sides have already reacted to the new paradigm, I would call it, in terms of the bilateral trade and investment relationship. So that's why I'm not very sensitive to or annoyed by all this saga that's happened last week after Trump's tweet or X or his comment on the social media.
Yeah. How might it affect the Chinese currency? Because, as we decouple, there's suggestions that the global financial system might de-dollarize as well.
Typically, the market will react to this type of news quite negatively, and that would cause some depreciation bias to the renminbi against the dollar. But at the same time, we know that this Trump's second term seems to have a very different impact on the value of dollar, at least to the global investor appetite to holding dollar. So there's a backdrop of de-dollarization across the world in the last few months. And so the market reaction to that is a lot less. And Chinese exchange rate policy is always trying to keep the renminbi exchange rate stable. And I believe that will continue to be a policy tone of the Chinese regulators. But at the same time, they also see this as a window, for China to push for a greater use of the renminbi in their cross-border transactions and settlements. And they may also offer this as a substitute for other countries to consider or explore a new way to hold a reserve currency. So we call this renminbi internationalization and to push for a greater use of the renminbi as a reserve currency. So I think this is perhaps to me, is more a long-term implication of in terms of the financial cycle amid this economic decoupling.
It's interesting to see that stability in the exchange rate in a nominal terms, but in real terms, there has been a fall. Could you talk about how the renminbi can stand still, but China can still effectively devalue?
Investors used to think that China want to go for competitive devaluation. In this case, in our view, China doesn't need to do that because of domestic deflation. That offsets a lot of impact, first of all, from the tariff rate. If the U.S. consumer might have already been finding that Chinese goods are increasingly cheaper, not because they devaluate the nominal exchange rate, but because of the real exchange rate. They're not trying to devaluate it intentionally. In fact, the Chinese authorities are very worry about domestic deflation, and that's the reason why they push for this anti-inflation, which is a way an urge for the domestic supplier not to cut price too much. But the reality is the oversupply, and the supply-demand imbalance has already caused a very strong deflationary pressure, and that's result in a lower effective exchange rate in real terms.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, October the 14th. Catch you tomorrow with a look ahead to US inflation and the Beige Book numbers. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.